Today in this video, we're going to talk about assumable mortgages. That's all the rage they're talking about right now. Is it legit? And should that be an option you consider if you're looking to buy a house right now? Check it out. Hi, I'm Rhonda Burgess, and I'm a real estate broker and mortgage underwriter here in the Nashville, Tennessee area. And my firm is Southern Living Realty Partners. All right, let's go here right quick. I've been seeing, I'm sure you all have seen, different people pushing assumable mortgages now, and because with the interest rates being like at 8% on a 30-year fix right now, if you have a seller who is selling their house and they have a lower rate mortgage, and it's a government-backed mortgage, meaning it's an FHA or VA loan. I've even seen them talk about the USDA being assumable. We're going to touch that in just a second, okay? But it's like, yeah, see, you can just assume these people's mortgages. You can get their low interest rate, they 3%, they 4%, they 5%, whatever their mortgage is. This is one of those situations where I've done videos like this before, and I've told y'all what the guidelines say. The guidelines say they are assumable. They truly are. But it's just like with anything else. Just because it's written in the guidelines doesn't mean that it actually exists. Again, if it's in the guidelines, a policymaker wrote it, and a policymaker has never done loans, has never done mortgages, have never underwritten a mortgage, probably don't even know what a mortgage look like. Again, no, I'm not trying to dig at anybody, but it just does not work. Okay, so let's touch this. First of all, I saw an interview on, I think it was MSNBC, one of the shows, that talk about the economy, mortgages and everything. So they had this guy, they've come out with this new company, I forget the name, where they're looking at, helping people to assume other people's mortgage. Okay. And the reporter was like, okay, I understand what you're saying. Like the guy said, so many millions, like 3.2 million FHA loans are out there at a lower interest rate. Right. But the reporter was like, but you know what? I looked at the national statistics, and as of I think for 21 or 22, there had only been like 4,000 assumptions. 3.2 million versus 4,000. That's not, that's way less than 1%, right? And so the guy for the mortgage company was like, yeah, but that's why we're here and we're pushing this, to help people get into something, a more affordable interest rate. Let's talk about it. And even the reporter was like, the math ain't mathing. That's what he wanted to say. But I'm going to say it. The math don't be mathing. Okay. Because here it is. In order for you to assume my mortgage, let's go here. We're going to talk about FHA. Then I'm going to swing back around to VA in just a second. But let's say I have an FHA mortgage and I took out my mortgage in 2016 and my interest rate presently is 2.5. or 2.75, okay? And I have, if I owe 270 or something like that, and my house is worth 600, let's just use an even number. So you mean to tell me that you gonna come up with, what, $330,000 to assume my loan? Because that's what it would take to assume my loan. When you are assuming someone's loan, that means you've got to give them the difference between what they owe and what they selling the house for. So if I'm selling it for 600 and I owe 270, you need to bring me $330,000. Now, for most people, if you got $330,000, you can either buy that's a sizable down payment on whatever house. Even if you buying a $400,000 house, you done practically paid for it. Okay, so. Again, if you have $330,000, you can go get your own loan. You can go get your own mortgage. You can buy that rate down significantly because you can afford it if you run around with $330,000 worth of cash. Do you see how the math ain't mathing? Okay, so You saying that you doing these, you want to do these assumable mortgages to help, especially the first time buyers. What first time buyers walking around with $330,000? I mean, I'm tripping because I'm like, that don't make no type of sense. Okay. Now let's talk about the FHA being assumable. It is assumable. An FHA mortgage is assumable if you, as the buyer, pay that seller the amount, the difference, like I just went over, the difference between the sales price and what they owe. And then you also, as the seller, you have to make sure that you get a release of liability. Okay. So if Jane Doe wants to come by my house and I have an FHA loan, and Jane Doe gonna give me $330,000, which again, I don't know how that why Jane wouldn't just do her own thing, but okay. But still, I've got to get a release of liability from FHA, because even though she's assuming my loan, I'm still the party responsible. It's in your documents. It's in your deed of trust or whatever it is in your state, your mortgage or your deed of trust. It's in those documents. So you've got to, as the seller, I've got to get a release from FHA saying that, okay, Jane is taking over everything. When you do an assumption, you have to qualify. Jane has to qualify in order for FHA to release me and put the mortgage on Jane. So again, if Jane got $330,000, you would think she would qualify, or she could just go get her own loan. I don't know, but Jane has to qualify in order for me to be released from that mortgage obligation. You understand what I'm saying? So again, this ain't gonna be no easy feat. When I talk about how the guidelines may say one thing, but the actuality is something else. Okay, let me tell you this. I do not know any mortgage company, any lender who has an assumptions department. Let me say that again. I do not know of any lender, bank, mortgage company, anything, who has an assumptions department, meaning they don't see that loan very often. They do not see an assumption. Let me see, I've been licensed since 97. Yeah. And doing mortgages since like 2000. I guess, yeah, around about that long. How many assumptions have I ever seen closed? One. In 26 years, people, I've seen one. And it took 6 months to get it closed. So what I want y'all to understand is, just because these people push, you may start seeing realtors putting out there, oh, this house is assumable. It has an assumable loan. It has an assumable loan. Well, if you ain't got $200,000-$300,000, that's not gonna work. If you don't have enough to give them people the equity out of their house, because let me tell you something, just because the loan is assumable, don't think that people are just gonna give their house away. They're not gonna give it away. You're gonna have to come with cash money. Okay. So you got to make up the difference between the sales price and what they owe, the amount of their mortgage, and you got to qualify. And you counting on that person's mortgage company knowing how to do an assumption. You're counting on they've even ever done an assumption. When I tell you, if it's less than 1% have ever had an assumption done, have ever completed an assumption, do you really think that's something that these mortgage companies are pushing? No. Do you really think it's going to be done quick? No, it's not. Okay. So and like I said, you got to get the release of liability on the FHA side. Let's talk about VA. That's all my veteran borrowers, and y'all better pay attention to this. The one assumption that I have seen closed was a VA. It took 6 months because, we get our entitlement, so it's normally like 4 times whatever your base entitlement amount is. So people are pushing. I'm seeing this being pushed. Oh yeah, it's a VA loan. It's assumable. It's assumable, and you don't have to be a veteran. True. In theory, you do not. Again, this is another one of them things that's in the guidelines, but it ain't real life, okay? In theory, as a VA loan holder, a non-veteran person can assume my loan. Yes, you can. You can. Just like on the FHA example I just gave you. But here's the kicker. In order for me to get my entitlement back, it's in my best interest as the veteran to only let another vet assume my loan, because I need my entitlement back. So like my entitlement used to be like 144,000 or something like that. And then like 4 times that or whatever. You know what I'm trying to say? It's probably higher than that now, but I'm just saying that was the last time when I bought a VA, bought my house using my VA loan. But if that person that's going to assume your loan does not have an entitlement from VA, then you just gave away your entitlement to another VA loan. Let me say that again. If you let a non-vet who does not have an entitlement assume your loan, then your entitlement is still on that loan. You cannot use your VA loan to buy another house. What sense does that make? That don't make no type of sense. Because the whole reason why, number one, you are entitled to that VA loan. You put on them boots. You made that oath. You done served. So that's your VA loan. VA loans don't have, you got your upfront funding fee, but you don't have monthly mortgage insurance premium and stuff. You don't have no minimum credit score. You know what? Don't give away all your good benefits for your VA loan. And I'm going to tell you, the one that I seen close, it took 6 months to close. It was a son to the father. And it still took them 6 months. They was both veterans. They said they both had pretty good credit. You know what I'm saying? And so that the dad was wanting to move here. And so the son was going to buy another house here in Nashville, right? And he was going to let his dad assume that loan. It would have been simpler to sell him that house. It would have been simpler. That could have been done in less than 30 days. But it took 6 months for that assumption to get approved. So what I'm telling y'all is, don't believe the hype. Don't believe the hype about these assumptions. And if you are a veteran, you can let a non-vet assume your loan, but you can't. You are tying up your entitlement to be able to use your VA loan in the future. Okay, one more thing I want to talk about on these assumptions. Again, they put on there, I've seen it advertised that USDA is assumable. Okay, let's remember the basic tenets of a USDA loan. Yeah, it's got to be out in the rural area, but you have household income limits. You have household income limits. So depending on how many people are in your household, normally for like a family of 4, I know like here in Tennessee, I don't think you may be capped at like 100,000 or 101,000, or that may be at five people or whatever. What I'm saying to you is there's an income limit. You got to qualify. The person who's wanting to assume the loan, you've got to qualify for that loan just like you were that person. So it's not as simple as what you make it. So if you over the income limit, what's that going to do? You can't buy it. Can't buy it. It's not going to work. You don't reach the credit criteria, it's not going to work. And let me tell you something. In all them years of USDA, I've never seen an assumption. Never seen one. Never underwritten it. Can't tell you what it looked like. No, nothing. I've never even seen one closed. Even when I'm auditing on the backside and I have to audit closed loans, never seen one. Never, ever, ever. So don't let these people get you all gassed up into thinking, oh my God, I can assume a loan. Yay, this is how I'm going to do it. No, you have better chance probably getting struck by lightning than getting this done. I'm just telling you. It's just craziness. So in that same, I'm gonna find that video and I'm gonna link it in the description. But in the same video, the reporter was on it. I mean, he had done his homework for this guy come on here talking about, I forgot what he said his name of his mortgage company was or whatever. Anyway, so he say, okay, so he said, for me, he's telling the same situation. He said, for me, I've been in my house, 10 years. I got boatloads of equity. Who's coming with that type of money to assume my loan? Right? He said the same. He had the same question I had. Okay. So the guy say, well, see, we're not going after people who've been in their house for a while. This is mainly made for people who have bought a house in the past couple of years and they're looking to sell. Let me touch that. Nationally, statistics say that people stay in their house anywhere between 7 to 10 years. And your first house may be even longer than that. People don't move every year or two. Why in the world, if somebody, unless something done happened, somebody done died, or we done had quadruplets and we need a new house, or I'm sorry, the math still ain't mathing, because listen, why in the world would I have bought a house, let's say in 21, okay, in 21, and let's say I got a 5% interest rate. I don't even know what the interest rate was. It may have been lower than that. But let's just say I got a 5% interest rate in 21. Where in 23 am I going? People don't move like that. People don't move like that. Unless something has drastically happened. Now, I have had people that say, my mama or my grandmama, somebody done got sick and I either need to go home and take care of them, or I need to move them here or something, you don't even really see jobs like that. Even if people, were able to go and work from home during COVID and now they telling them to come back in the office, I don't see people giving up and just selling in less than 24 months. That's something that you just do not see. That's why, to me, this don't make no type of sense. I don't see this being successful. I don't see this being successful at all. And then he said, well, and then so the reporter again on point. He said, well, what if I ain't got, let's say it's $100,000 that you would need to assume these people loan. And what if I don't have it? He said, the mortgage company guy said, well, we got another lender who will do a second mortgage for you. And then your blended rate of the rate that you assuming plus the second mortgage should still be cheaper than the going rate today. Let me tell y'all something. Back in the day, before the mortgage crash, we used to do so many 80-20s. 80-20 loans, meaning we got an 80% loan over here from one bank, and then we got a 20% loan over here from this other bank. So that way you didn't have to deal with doing the conventional thing. If you didn't have the 20% down, we just got you a 20% mortgage, and that way you didn't have to do mortgage insurance and everything. That mortgage on that second loan is going to be at least 12, if not 13%. Because otherwise it makes no sense for that lender to do that loan. They're not making any money. If the going rate right now is 8, and so you telling me you want me to loan you, to give you a mortgage, and I'm going to be in the second position, meaning if you stop paying the mortgage, I got to wait until you pay off the big boy that got the 80% loan. And I'll get the scraps that's left. Are you serious? And so I'm going to do this for what? I'm going to do this for how much? Man, let me tell you something. If they're not getting at least 13%, if they're not getting at least 5 basis points, it don't make no sense, because they're not making any money on that mortgage. They're not making any money whatsoever on that mortgage. So again, you done got back into, is this really helping you? Because if you got an 80%, if I got to bring $100,000 to get the 80% loan, or to assume this loan, and I ain't got all of that money, so then I got to go over here and borrow some other money at like 13%. Do you see how this don't work? Do you see how this don't work? I just don't want y'all to get caught up in the hype of, this loan is assumable and that loan is assumable. Oh my God. Listen, do the math. The math ain't mathing on assumables. If this was the case, if this was really viable and this was really working, we would have as many assumed loans. We would have as many assumptions each year as we have originations. So if we're originating 1 million FHA loans a year, let's just say if there's 1 million new FHA loans a year, then there should be at least 500,000 assumptions if it really was to work. But you see that it don't. You see that it don't. Don't get caught up in this, thinking this is the way that you're going to get into a house is through an assumption, because it's not. I just don't see it happening. Again, my name is Rhonda Burgess, and my firm is Southern Living Realty Partners. If you need help with finding a home here in the Middle Tennessee area, we will be glad to help you. Our contact information will be in the descriptions. Thank you, and as always, have a blessed day.